Equities just about turning positive in the last 30 minutes or so, a rally in the Treasury market off the back of jobless claims coming in just a little bit higher than anticipated. Your equity market positive 0.1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Ferro.
Live from New York, coming up, Chair Powell softening his tone on day two on Capitol Hill. President Biden delivers his budget request to Congress, and jobless claims inching just a little bit higher. We begin with the big issue. It's payrolls. Up next.
We've got key data coming up.
On-farm payrolls, a big important print.
The payrolls report on the 10th.
We're still looking at a labor market that is extremely strong.
50 basis points is very much on the table.
Chair Powell opened the door, but it's up to the data to decide.
The labor market is still strong. Inflation is sticky.
If we don't see February kind of reverse some of January's strength, it's likely we do go 50 basis points at this next meeting.
200,000 on payrolls is an improvement, but it's still too hot.
It will matter a lot to markets if it is 50 basis points.
If there's an upside surprise tomorrow, and if there's upside surprise on CPI, the 50 is definitely on the table.
We're certainly all beholden to the data at this point.
The proof is going to be in the pudding.
Payrolls tomorrow morning, then on to CPI next week. With us, PGIM's Lindsay Rosner and Colin Martin of Charles Schwab. Lindsay, first to you. Day one, day two. Day two with Chairman Powell felt like a slight walk back from day one. Did it change much for you?
It didn't. Certainly felt like a little bit of a walk back, but I think we all heard it loud and clear on the first day, which was the data has not given them much room to do that stair-step function that we thought was the plan, which was take it down to 25 basis points next time. Instead, we are now hanging on to every data print that we're going to get over the next week to figure out if it's going to be 50, and it very well could be.
We're data dependent. How low is the bar right now? 450. Citi tries to answer that question. They look for 50 from the Federal Reserve. These are their numbers. They're looking for 0.5% month-over-month core CPI next week. Tomorrow morning, they're looking for 255,000 in the payrolls report. Colin, I guess that's the question to you. How low is the bar, and does 255 and 0.5% month-over-month core CPI get it done?
I don't know if that does get it done. I think the bar is still relatively high, because if we look at the jobs picture, clearly last month there was a blowout report, but we know that 1 month doesn't necessarily make a trend. So when we look forward to tomorrow's report, if we get another blowout number, I think that certainly puts the odds of a 50 basis point rate hike significantly higher than where they are right now. If it comes in the high twos, even low threes, I think you need to then pair it with a very, very strong CPI report. Again, we don't want to look at too much at 1 month's numbers. As Powell mentioned, they look at the totality of the data that's coming in. So I think the bar is relatively high, and a kind of modest outperformance or slightly up positive surprise tomorrow, that probably won't move the needle in our view.
What if it is a big number? What if next week is a big number too and they go 50? Bob Michael of JP Morgan Asset Management spoke to our colleagues here at Bloomberg, and he said to go back to 50 would be pretty confusing to the market. I hope they don't do it. I hope they're willing to run a string of 25 basis point increases. Lindsay, why is that important? Why would it be confusing if they return to 50, even if the data justified it?
I totally agree with that comment. The move back to 50 is just not the playbook we thought we had. And so what we thought we were trying to figure out or wrap our heads around as investors was, when does this end? And they're at this pace from 75, they go to 50, they go to 25, and then they stop. And the idea that they could go from 25 to 50 and do that jump, well, that's explained a lot of volatility that's happened in the market in the past few days, because it wasn't the course that we thought we were on. I think the really important thing here is that the Fed is, yes, data dependent, but it's not a self-driving car, right? There is still a human being behind the wheel. And so with this data, there is some human finesse. I think we're trying to figure out how good is that human finesse, and is it going to be good enough to make sure that we don't get into that recession that people are fearing.
Lindsay, as you've suggested, we've had 2 years' worth of narratives in 2 months. And as you pointed out, the divided line between those 2 months was that Feb 3rd jobs report from a month ago. And it made me wonder over the last couple of weeks, Lindsay, and I wonder how you feel about this, just how brittle both arguments are on either side of all of this for them to break down in the way they did with one jobs report, 1 month of data.
Yeah, I think that's a great point. The world has been different since February 3rd. It was funny when I was thinking about what to say today. February 3rd really lines up perfectly with the groundhog, right? He predicted winter. Maybe we should have been listening to him. This week's data will tell us if we're going to, in fact, have spring. But the point that you're pointing out is that we are swaying in the wind with every data print. And that's kind of a challenging place to be in. I think on the bright side, what we do at PGIM is pull that camera back and be long-term investors. But in the immediate and thinking about day-to-day positioning and trading, it's gotten really complicated.
It was the dilemma of last year. If you can't price the risk-free rate, how do you price risk? And here we are again, struggling to price the risk-free rate. Deutsche Bank pointing out, what on earth is sufficient restrictive? Matt Lazzetti over at Deutsche Bank saying this: the market should not be comfortable with the notion that a terminal rate near 550 is sufficient. Colin Martin, what is sufficient?
You know, that's what we're all trying to figure out right now, John. What we look at when we look at the natural rate of interest is one of the Fed models, but they discontinued or suspended that model once the pandemic hit. You know, going into the pandemic, that natural rate of interest had been falling for years. It was in that 2 to 2.5% range. But as you alluded to, maybe it's a lot higher right now. Maybe not necessarily structurally, but at least cyclically. Because what we've seen in the markets, we've seen a lot of tightening in Fed policy, but not tightening in financial conditions. I think that's one of the confusing issues when we hear those comments from Powell. What is it that he's referring to? But when we look at the economic data, when we look at the strong labor market, when we look at that, you know, positive surprise with retail sales last month, clearly a rate of almost 5% isn't really restrictive right now. So I think that's what we're trying to figure out. And I think that's what we're looking at when we look at our guidance for our clients at Schwab. If it's not restrictive enough, and the Fed does need to hike more than expected, and the economy can withstand that, then maybe we see all yields rise pretty much all across the curve. That's not our base case right now. We think long-term yields are probably going to remain relatively anchored here for now. But if the economy is strong enough, then we could see a move up pretty much all across the curve.
Well, yields have fallen this morning off the back of this. Jobless claims about 37 minutes ago coming in at 211. The estimate was 195. Equities up by, let's call it 0.25% on the S&P 500 into positive territory. In the bond market, yields are lower at the front end by 7 or 8 basis points to 4.99. That's just a slight upside surprise. And it's generated a move of 7 or 8 basis points on a 2-year yield to 4.99, just below 5%. Mike McKee, go through the data for us. Jobless claims, what do you make of that?
Well, we have been waiting for claims to go up because of all the layoff announcements we've had and because the Fed has been raising interest rates. And you're supposed to lose jobs when the Fed raises interest rates. And it looked like we did this time. 211,000 is the total for last week. First time since the first week of January, we were over 200,000. Unfortunately, this has turned out to be something of a head fake. And this comes from Stephen Stanley at Amherst Pierpont Santander. He notes that every time New York schools go on vacation, which they were winter vacation last week, you get a spike in jobless claims because the school workers can file. And so we saw an increase of a little over 16,000 in jobless claims from New York State. And you can see all the bumps every time that happens. And that would have left us below 200,000 again if that hadn't happened. So our neat little tied in a bow story doesn't exactly work. However, as we get ready for tomorrow, there are some reasons to think that we could see the numbers go down, not just the statistical reasons, but take a look at this. The Fed's been raising interest rates, and at the same time, we have seen strong housing construction that is now falling off. The number of building permits has dropped dramatically, and yesterday we got the JOLTS report. The number of job openings for construction workers fell by more than 200,000, almost 250,000, one of the biggest drops ever in that category. So theoretically, that stuff should start to show up. Maybe it shows up in tomorrow's payroll report. You can see, though, what John was just talking about in terms of the reaction of the markets. I mean, since February 1st, everybody has priced in the idea of 50 basis points and the idea that the Fed's going to raise a lot. And we've all been warning, hey, let's wait and see what the data say. Data today may be a head fake, but it has moved the markets. So tomorrow, there is certainly market risk to the payrolls report.
We've had a 100 basis point move at the front end of the curve in the last month or so. Mike McKee, thank you. Looking ahead to payrolls tomorrow, median estimate right now, 225. The range we've got, the high estimate, 325 is the high, the low is 100K. The previous number, as you know, we've talked about it almost every single day over the last month, 517,000, which was just unbelievable. Looking at this yield curve right now, 2s, 10s, negative 103 basis points. Yesterday, off the back of ADP, negative 110 plus. Just incredible to see this kind of stuff. We haven't seen it since the early 1980s, 1981 to be precise. Lindsay, as you look across this yield curve, we were told it was the year of bonds. Hasn't quite turned out that way. It's certainly the year of income. Where do you look to take that income right now?
Yeah, I think that's a really good distinction that you just made. We haven't changed our tune in terms of the fixed income market giving you opportunity. That opportunity is still there, and you still have the ability to do the right thing, which is you can stay in front end carry paper, whether that's the investment grade universe, selective names in high yield, really high quality structured product, which is a favorite of ours, and you can earn that income. That's really important. I think the other thing, though, when you pull the camera back, is that this is, I think, the year of the bond, or we think the year of the bond, but it's March, right? And we never said it was going to be a straight line. So we're a couple months in, we've got a long way to go. And that's where finding those the right kind of collateral, the right kind of paper that gives you a lot of spread, that's the place to be.
Well, high yield spreads are certainly tighter over the last year, that's for sure, well off the wides of last year. We were inside 400 basis points earlier this week. We've widened back out in the last couple of days to about 4 percentage points. Colin Martin, you didn't like credit before. You don't like high yield now. What is it about it that you don't like?
Well, mainly those credit spreads that you alluded to. We think it makes sense to take risk if you're being well compensated for it. And right now, you simply aren't. I think a lot of investors might see that juicy yield that high yield offers, right, around 8.5% on average. But about half of that yield is strictly from the level of Treasury yields. Again, levels we haven't seen in multiple years. But the risk premium is low. And three things that we really focus on that gives us a little bit pause and why we suggest caution as we enter now is, one, that low level of spreads. Two, historically, when the yield curve is inverted, high yield bonds tend to deliver negative excess returns relative to treasuries. We look at that in just in absolute terms of, is it simply an inverted yield curve? But as you mentioned before, negative 100 basis points on 2s, 10s, it's severely inverted. So we think that's the second risk. And third, just the general outlook. When you look at things like the ISM Manufacturing Index, that downward trend usually results in higher spreads, and we just haven't seen that yet. So while the all-in yield probably looks attractive for a lot of investors, we'd rather wait for better opportunities, even though we continue to kind of push back that potential arrival of the recession. We'd rather not take that risk now because there's so many attractive yields with high quality options now, and we wait for better opportunities with high yield down the road.
You're not the only one who said that. They're looking for higher yields, wider spreads later on this year. Lindsay, don't fight the Fed is a phrase a lot of people throw around on programs like these. Don't fight the Fed. What does success look like for the Fed? And what does that mean when you think about where you want to take risk? If I don't want to fight the Fed, what should I be doing?
Yeah, no, it's definitely something you hear all the time. If you don't want to fight the Fed, I think it goes back to finding the companies that are going to win. And the high yields that Colin was alluding to, yes, that's on the whole index. But if you can pick apart that index and find the names that are giving you those high yields and you think you're actually going to realize them, that's what you should be doing. And you can safely do that in an environment where the Fed is going to have to hike. Even if they do hike 50 basis points, if you are comfortable with the balance sheet of the company that you are investing in, you will get paid. And I think that's the way to handle it.
Lindsay, Colin, sticking with us. Equity futures right now up 0.25% on the S&P, about 16 minutes away from the opening bell. Let's get some movers. Here's Abby.
Hey, John. Well, a piece of that bullish action is GE. Shares of the industrial company are set to open at a record high. This as the company yesterday did provide an update on some of its operational guidance relative to aviation and energy. They're now saying that they're going to see mid to high single-digit revenue growth over the long term for GE Aerospace, and they're going to generate free cash flow that will be in line with net income. Shares up 2.6%, and since the beginning of December, this stock up more than 25%. The S&P 500 down, so really outperforming. Now, speaking of down, Silvergate, well, it is absolutely plunging again now, almost down 100% from its peak. This, if you can believe it, was a more than $200 stock just a little while ago, but one of crypto meltdown's big first casualties among the mainstream banks. This is not entirely surprising, but the company has said that they're going to be winding down and returning all deposits. They did warn of going concern risk last week. That actually appeared to weigh on banks last week, but right now we have Bitcoin down just a little bit. Let's watch the financials on the day, but seems relatively isolated to Silvergate.
Abby, thanks for that. A story for the opening bell as well, about 15 minutes away. Coming up on this program, President Biden unveiling his new budget.
The president wants to lay out in a transparent way to the American people how he sees us moving forward. And the president's going to go to Philly to speak to that.
That conversation up next.
It isn't that the debt today is unsustainable, it's that the path is unsustainable. This only winds up one way, and that is with Congress raising the debt ceiling. No one should assume that the Fed can protect the economy from the non-payment of the government's bills, let alone a debt default. There are no rabbits to be pulled out of hats here.
President Biden preparing to reveal his budget proposal amid a looming debt ceiling standoff.
The president budget will cut the deficit by nearly $3 trillion over the next 10 years. That's nearly a $6 trillion difference between the president's budget and congressional Republicans' agenda, which would add $3 trillion to the debt.
The president expected to defy GOP calls for deeper spending cuts, proposing a series of new taxes instead, targeted at large corporations and wealthy Americans. Speaker McCarthy shooting down the prospect immediately.
You could always find common ground, your willingness to do that. I have not seen his budget. I do not believe raising taxes is the answer. I've had this discussion with the president personally.
Let's get to AMH down in D.C. Morning, Anne-Marie.
Good morning, John. Well, you can think of today's budget unveiling from the Biden administration really as a wish list for the Democratic Party. These are provisions and ideas. We've heard them before. The Biden administration campaigned on them, and they also were discussed when they had control of the Senate and the House. So things you're going to hear about is raising taxes on billionaires. They want to increase taxes when it comes to capital gains. They want to go after provisions that help, say, the oil company or private equity or venture capitalists. But again, as Greg Vallier put it, this is really all aspirational. But it's important. You might think, why do it then? Because what this administration is trying to show is that they have a distinctive plan that is different from the Republicans when it comes to the fiscal health of the future of the U.S. economy, especially as they're about to go into a really brutal battle when it comes to raising the debt ceiling. And then second, of course, this is really, you can envision it as a campaign event. The president is widely expected to announce a re-campaign for 2024 bid, and he's showing the Americans this is what he wants to do, and it polls well.
Polls very well, as we know, particularly some of these issues. AMH down in D.C. Anne-Marie, thank you. We'll catch up with Anne-Marie a little bit later. You'll hear from the president, no doubt, a little bit later as well. Dead on arrival was just a phrase that was put in almost every single headline I saw associated with this address. But to Anne-Marie's point, really laying the foundations for a run for 2024 and a second term for the president. Futures right now up 0.25% in the bond market. Things are calm. For once, your yield is much lower by 8 basis points, 4.99 on a 2-year. Lindsay Rosner, later this year, we'll be talking about a debt ceiling debate. And I think we've all asked this question a few times. Is this time different? And if it's not different, does that concern you about how far they might push it in Washington?
Well, the piece of it that I'd be concerned about if it's not different is if we don't figure out a way to deal with it. Historically, as you're aware, we've always found a way. This, I think, the Biden plan, what we know of it so far, at least, you can think about it as that's the opening hit in the tennis match. We're going to have a lot of back and forth between now and then to figure out the debt ceiling and how to make it work. My hope, because it's important for markets and stability in the U.S. going forward, is we figure it out, and I think we will.
Chair Powell says no rabbits coming out of the hat. Colin, what does all this mean to you? How do you see this playing out in the next 6 months?
Well, probably more 6 months as opposed to near term. It looks like we'll see a lot of squabbling between now and that date when the extraordinary measures expire. Our hope is that there is some sort of plan to kind of take the uncertainty out of the equation. But given kind of the bipartisan nature or partisan nature in Congress right now, that doesn't really seem likely right now. So as we get closer to the date, we think we'll see a repeat of probably what we saw in 2011. If there's a growing risk that they can't come to some sort of deal, you'll probably see Treasury bill prices of bills maturing around that date fall a little bit, because no one wants to be holding a bill whose prepayment will be deferred. So I think that's the big risk. We'd likely see risk assets fall pretty sharply. We saw that again in 2011. And we probably see long-term Treasury yields fall and their prices rise in a flight to quality bid. But again, I think we're a long ways from there, because just the nature of politics today, it looks like they'll keep kicking the can until we get closer to the date that those extraordinary measures are expiring.
But Colin, that was the money question. You mentioned it. Sure, you'll get that kink in the T-bill curve. Everyone expects that. Fine. It's what you do further out. Lindsay, if it hits the fan, inflation's still elevated. Am I buying the 10-year when things get dicey?
Yeah, I think that's probably a better place to be. If you think about right now what's happened with the 2-year, a lot of people have sought safety in the 2-year part of the curve, right? Well, what's happened so far year to date is the 2-year yield has just gone up, maybe with an exception for a little bit this morning, but it's really been one direction. So your price is down, your yield is up, and people were sitting there safely in the 2-year point of the curve thinking that they would just be able to wait there until they found better opportunities. Well, your waiting has actually cost you. So I think that idea of moving out the curve where you're actually getting a real rate makes more sense. But certainly the whole question, if there's a U.S. default, makes it more challenging.
Lindsay, great to get your views on that. Lindsay Reisner there, Colin Martin on fixed income markets going into payrolls tomorrow morning. Good morning to you. Up next, your morning calls, and later, the case for cash and value with Bank of America's Jared Woodard. That conversation just around the corner. Your opening bell 7 minutes away. Four minutes away from the opening bell. Equity futures just about positive, up 0.2% on the S&P. Let's get you some morning calls briefly. Your first call from Jefferies, downgrading Etsy to underperform from buy. Warning shares could fall by 25% as consumers cut back on spending. That stock's down 4.5%. Barclays upgrading Hilton to overweight, 168 price target, noting the company's underappreciated growth prospects. And Citi raising its FedEx price target up to 250, seeing potential upside to Q4 results next week. We're positive there, about 1/4%. Up next, Bank of America's Jared Woodard looking for opportunities in high quality and smaller value stocks. That conversation up next, your opening bell, just around the corner. Live from New York this morning. Good morning to you. About 20 seconds away from the opening bell, with equity futures just about positive, up 0.2% on the S&P. On the Nasdaq, up a little more than 0.1%. You can thank the jobless claims report for these gains. Claims coming in just a little bit softer, higher than expected. That pushes equities up and yields lower. Your opening bell in New York rings. Switch at the board and get to the bond market. Yields look a little something like this. They're lower by a couple of basis points to 396.78, much lower at the front end of the curve. Your 2-year yield had been climbing for 3 straight sessions until this morning. Your 2-year is lower. Yields down by almost 9 basis points now, 498 after going through 5% the other way. We dropped back below 5% this way. So let's call it 498 or maybe even 499. So yields come in, jobless claims soft, payrolls tomorrow, going into payrolls, 105.73 on euro dollar, slightly stronger euro, up 0.25%. Fascinating spat on the ECB Governing Council. The Austrian Central Bank Governor said he wants 4 more 50 basis point hikes, potentially. And then I think the Italian Central Bank Governor came out this morning and said he does not appreciate committing to future conversations at future meetings. So the Governing Council later this month is going to be spicy. Euro dollar just south of 106, crude 77.40. On WTI, we're positive there 0.9%. Almost a minute into the session, equities positive 0.2 on the S&P. The Nasdaq did lead yesterday, lags a little bit today, up 0.1% on the Nasdaq. One stock to watch at the open, JD.com. Shares under pressure after growth of first-party sales fell short of estimates, with lockdowns weighing on consumer spending. JD.com down 6%, Abby.
Yeah, pretty brutal day and a 6-down day in a row, the worst losing streak since July of last year. And it's interesting, John, because they put up a fourth quarter that on the surface looks okay. They actually beat adjusted earnings in a big way. Revenue's basically in line, but beneath the surface, less so. Now, the sales from their first-party sales in the fourth quarter missing the mark, so investors not liking that. And in addition, COVID disruptions hitting sales of electronics and appliance categories. The EBITDA and earnings blew past estimates amid the cost-cutting efforts. So again, mixed results here for JD.com. Now, one positive, they did announce a cash dividend, but not enough for investors at this point. Relative to sales overall, while they grew 7% and were basically in line on the surface, they're moving in the wrong direction. Back in 2015, sales were growing year over year by more than 60%. So 7% now on these COVID disruptions seems relatively low. And on the year, JD.com is one of the China tech companies that is underperforming. Overall, the NASDAQ Golden Dragon Index up about 4%. JD.com, though, down 23%. And again, they are paying out a cash dividend of 31 cents sometime around early May. A lot of analysts saying that this shows their confidence in profitability and cash generation. Investors really not caring today, again, with that stock. JD.com down about 6%.
Abby, thanks for that. Just to keep you up to speed on Silvergate Capital, we talked about them a little bit earlier this morning. At the opening, bow down almost 40%, negative about 39% right now on Silvergate. On the plan, of course, to wind down the bank, that stock is getting absolutely hammered. Also watching Uber as well. The company said to be considering a spin-off of its freight logistics unit. This after the CFO highlighted the challenges going forward due to the cyclical downturn in the business. Katie Lyons has more. Hey, Katie.
Hey, John. Yeah, for context here, this operates as an independent unit. It essentially matches trucking companies with those that are looking to transport loads. And obviously, given a downturn in trucking, it is a business that is struggling. And now, from Bloomberg's reporting, we understand it may be spun off either via a sale or as a separation out into a separate publicly traded company. An IPO, from our understanding, seen as a more likely option. And while Uber is discussing its options with potential advisors, we understand that no decision necessarily is imminent at this time. But still, though, you're seeing the stock up the better part of 1% in the first few minutes of trading this morning. Why would Uber do this? Well, to streamline its focus on its other businesses, ride hailing and food delivery, which do represent the bulk of its revenue, nearly 80% relative to just the 22% of revenue that it comes from freight. And again, that is a business that has been lagging while those other businesses are growing. And it is Uber's diversification that has helped it from a performance perspective. For context, John, relative to its peer Lyft, Uber's up about 38% year to date. Lyft is down 11%, and that outperformance has really been continuing for years. The sell side also really positive on what potentially could happen to the stock if indeed we do get this freight spinoff. Our analyst here at Bloomberg Intelligence thinks it will help Uber from a cash flow perspective. And Piper Sandler actually saying when you couple this potential move with New York City changing its outlines for what gig workers are going to have to make by 2025, that could mean that Uber actually might get added to the S&P 500.
Interesting. Katie, thanks for that. I've got that note from Piper Sandler in front of me on the possible spin-off. So let's build on that a little bit. Just an extra flavour from the analyst community this morning. They say this: we think divesting Uber Freight would be a good idea. There's some theoretical advantages to running a digital freight platform alongside Uber's better-known delivery segments. But in general, we think the freight business makes more sense as a standalone entity. That from Piper Sandler a little bit earlier this morning. That stock is up, of course, Uber by about 0.9%. Let's stick on tech. Tesla, among the biggest laggards this morning, as Wall Street puts a 50 basis point rate hike back on the table. The EV maker faces yet another investigation from regulators on a potential defect. Ed Rudlow has the story. Morning, Ed.
Yeah, good morning, Jonathan. Literally in the last 30 seconds, we've completely turned the corner on tech. Tesla now higher, actually, by around 0.2%. It is heading, though, for its worst week of the year so far, or matching its worst week of the year so far. NHTSA and regulators are looking at an issue that affects a very, very small, less than 0.02% of all vehicles out there on the steering wheel potentially falling off. I'm not so sure that's having an effect on the stock this morning. The narrative around rates has really kind of been the talking point of the week so far. It's impacted not just higher multiple stocks in the software space, but also the mega caps. I remind myself this morning, looking on the Bloomberg terminal, that Tesla in particular is a stock that trades at 45 times forward earnings. And you have to keep reminding yourself of that, John, because of the news flow around it. We're now up 0.5 percentage point on Tesla. That chart's really interesting because there are a number of analysts that have added buy calls on the stock in recent weeks, particularly following that investor day, March 1st. I would also point out that's not universal. A number of analysts have also cut their price targets on the stock as well. There's a note from Morgan Stanley this morning to wrap this up, John, saying Cybertruck in particular is a sideshow, quote, and could be a lower volume or sort of lesser bought products going forward. So a lot to digest, but right now, Fed. What I think is really interesting year to date, look at that 2-year and short-term rates.
I know.
But look at the performance. Unbelievable.
It's unbelievable. To see that move at a 2-year and the outperformance of some of these tech names has just been phenomenal to see. Very unexpected. Ed, thanks for that. Thank you very much. Not the story this morning, but certainly the story of the year so far. The S&P 500 up 1/3 of 1%. The Nasdaq just about being outpaced by the S&P 500 today. It's up by almost 1/3 of 1%. Jared Woodard of Bank of America has this to say. He says, go beyond the benchmarks. Falling goods prices suggest owning deflation assets like growth stocks and bonds, but impressive strength in jobs and consumption hint at a second inflation surge, favouring value, resources and cash. Let's make sense of this. Jared, I'm pleased to say, joined us right now. So, Jared, let's start in the obvious place, off the back of the work that Ed Ludlow just did for us. You've got this big move in 2-year yields and this outperformance in the Nasdaq. Saw it again yesterday, on a session yesterday, Jared. Why is that happening?
Well, John, I'm glad to be with you, and thanks for having me. I think that the move that you're seeing in markets this year is one in which investors realize that the deflation story and the related assets that worked so well immediately after COVID, the inflation story and the related assets that worked so well last year are both a little bit more fraught and a little bit more confusing, and so it's a year not for inflation or deflation, but for diversification. The challenge that we find, John, when we look at the longer run history of assets over the past several decades is that diversification is a lot more difficult now than it used to be. This is the 30-year anniversary of the creation of the ETF, which we cover, and I can tell you that when the first ETF launched in 1993, the average correlation among the stocks in the S&P 500 to each other was around 10%. Today, the average correlation among the stocks in the S&P 500 to each other often approaches 50%. In a crisis, as you well know, it can go much higher. So buying the equity index was a great way to diversify your portfolio 30 years ago. Today, everything increasingly looks like all one trade. And it's not just true for the S&P, John, it's true across every asset class, every sector, every region of the world.
Jared, when you screen for uncorrelated diversification in the environment we're currently in, and you can describe that environment for us as well, because I'm getting a little bit lost so far year to date because it switches from one month to the next. Where do you find that diversification now?
Well, I mean, our first piece of advice to investors is not to get shaken out this year of the inflation hedges that you built into a portfolio last year to become a bit more robust against what sure looks like structurally higher interest rates and inflation and wages and other kinds of cost pressures. If that's your view of the macro world, it's our view, then you need to have a portfolio that's more robust to those kinds of threats, something that most investors in, say, a 60-40 conventional portfolio have not had to think about for a long time. So I think, number one, don't get shaken out on the inflation side. Number two, it's very likely that we see a recession in the United States this year. And so there will be a moment, probably multiple moments, in which the deflation beneficiaries, especially tech stocks, government bonds, enjoy short-term tactical rallies. For investors who want to take advantage of those, I think it's fine to be aware of those and to move accordingly. But the main thing to do, I think, for the broadest swath of investors is to look for places that are less correlated. I can tell you it's not European equities, which have gone from 30% to 90% correlated to the US. It's not even high yield bonds, which have gone from 30% to 80% correlated to stocks. It's going beneath the big benchmarks, beneath headline regions. It's a bit more difficult, although with ETFs and other products, you can be a bit more nimble today, no matter who you are, than ever before. One metric we do like is free cash flow yield as a measure of quality. That's been a fantastic performer and a way to navigate trends that focuses on the real underlying fundamentals in a business and isn't so dominated by interest rate exposure or macro stories or other kinds of things. Within regions of the world, we like emerging markets ex-China as a place to capture strong productivity, strong growth potential without some of the risks that are very obvious to investors these days around investing in China or in some other parts of international equities. I would say, John, lastly, most investors still haven't made big changes. And one thing that we're watching, I think it's be very important for a major market low, is outflows from household active investors. You've seen that around all the major turning points. After the dot-com bubble burst, after the great financial crisis, these turning points in markets were always marked by big outflows from household investors. And we never saw that last year, despite the bear market. We haven't seen it this year. I think once investors understand that cash is attractive, maybe credit is attractive, equity earnings are pressured, equity price returns look less likely, you'll likely see those outflows this year, and I think that'll get you on your way to a more sustainable bottom in this market.
And Jared, a conversation I've had with a couple of investors already so far this morning, they've just offered the reasons why they like credit over equity. And the reasons they like credit are pretty clear. They believe that companies, corporate executives will be forced to make decisions because of high interest rates that benefit credit holders over equity holders. Now, you've made the point, and this stands out for me in terms of your calls. Within high yield, you like fallen angels. So for people who don't follow the credit market, that means you drop from investment grade down towards high yield to junk status. Jared, why do you like those names?
I like those names, John, because fallen angel corporate bonds, these are recently downgraded with some potential to be upgraded, have been fantastic performers across a full market cycle. In fact, when we look at risk-adjusted returns across maturities and across credit ratings, those fallen angel, highest quality, high yield bonds have historically been some of the best performers on a risk-adjusted basis over a cycle. It's absolutely true. Those are still somewhat cyclical businesses. They've been downgraded for some reason. But the reason I think that that particular category has done so well is that they benefit from the kind of mispricing and the liquidity that shifts when you're downgraded from investment grade to high yield. There's some forced selling that happens, and historically those companies have often been able to repair themselves, get upgraded again, become eligible as investment grade again, and see huge benefits. So investors who want to take advantage of that dynamic and who are able to ride through what's likely to be a meaningful recession this year, I think we'll be able to pick up some yield at really attractive prices. And I think as markets start to price in recession risk more seriously, you'll have multiple opportunities this year to add to that position.
Jared Woodard, smart. I think the difficulty there is to play the recovery to the recession before the recession has even started, but that's maybe a conversation for another time. Jared Woodard, thank you, sir, as always, from Bank of America on credit. Some really important points there, and not the first time we've heard that point so far this morning on Bloomberg TV and on Bloomberg Radio. About 14 minutes into the session, no real drama here, up a third of 1%, just kind of waiting for payrolls tomorrow morning. Coming up, big banks bracing for tougher times ahead.
We'll redeploy people across the franchise, including investment bankers, to other parts of the franchise to help us in the middle market investment banking.
That conversation up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Ireland's Finance Minister, Michael McGrath. That conversation at 1:30 p.m. Eastern, 6:30 p.m. in London. This is Bloomberg.
We'll redeploy people across the franchise, including investment bankers, to other parts of the franchise to help us in the middle market investment banking. So you can move it. Our headcount peaked in January. It's down a few thousand. It can move, but you had to stop hiring, and that's what we had to do last fall.
The big banks warning of challenges ahead. Bank of America redeploying investment bankers as the deal drought continues. This coming as Citigroup forecasts a drop in trading revenue.
We are likely to see a mild recession, likely in the back half of the year. It's likely that we do see rates come in higher than we were expecting when we ended the year. We think that's likely to have an impact on GDP and result in a mild recession.
Our chief Wall Street correspondent joins us right now. Morning, Shonali.
Morning, John. Listen, usually higher interest rates are a very good thing for banks, but in this instance, they were supposed to start stabilizing by the middle of this year, according to Wall Street's expectations. With those expectations thrown out the window, you have a big stifling of not only deal activity, but that boon that the big banks got from trading has also started to diminish. So that conversation with Mark Mason over at Citigroup, he talked about the pipeline being under the surface, this pent-up demand to do things among corporations and among the buy side. But listen, at the same time, with all of that uncertainty, it's hard for those things to come to fruition anytime this year. So really, really steep drop-off here. And the longer you see these 50%, 40% drops-offs in wallet for investment banking, the harder it gets for these banks to keep people on board. Over at Bank of America, not only did they stop hiring, they also said attrition is their friend. But guess what, John? Attrition is no longer really happening all that much on Wall Street. You're seeing a lot of these banks saying people are staying on board because of lack of options elsewhere. This year is shaping up to be a tougher job market for bankers as activity remains so stifled.
There are, of course, Wall Street problems, and then there are Credit Suisse problems, and Credit Suisse wishes they had Wall Street problems, and they don't right now. Shonali, thank you. They have Credit Suisse problems. Here's another one. Delaying the publication of its annual report, sending shares lower for a fourth consecutive session, on track for its lowest close on record. The move following a last-minute query by US regulators over previous financial statements. That stock is down hard intraday and recovering just a little bit in the last couple of hours. Jan-Patrick Barnett joins us right now for more. Jan-Patrick, we talked about it a little bit earlier. The stock was down 5-6% at that point. It's recovered since. Could you tell me what exactly US regulators are asking?
Well, we don't know this in full detail, but the questions are about like the bank's financial statements regarding its cash flow in previous years. And as you said, this is another problem for Credit Suisse, and those problems are just piling up. And the last thing that Credit Suisse wants at this point, but it's trying to pull off a very complex restructuring and turnaround plan, is another bad headline. And you can see that in the stock today, slumping as much as 6% before recovering, as you said. It's just like the doubts are rising that the bank is really able to pull this around, and what Credit Suisse really would need at this point is some positive headlines to stabilize its stock, to stabilize the sentiment about around its name, and more importantly, to avoid that more clients are pulling their money and walking out of the door, because this would then in turn, of course, increase earnings pressure in the coming quarters and make the turnaround even harder.
And not for me to say that they'll lose more clients, but they've certainly lost a big investor in the last few months. Jan-Patrick, we know that David Ferro of Harris Associates sold his entire stake. How have they responded to some of that?
Well, they haven't, and that's also an issue for Credit Suisse, that the communication right now is not great. What we are seeing from the management, from the bank overall, all we get is negative headlines, very little from the bank. Of course, they stick to the turnaround plan and they want to pull this off, and maybe sometimes it's a good thing to rather stay quiet when you are in trouble. But still, at this point, Credit Suisse needs to show a little bit more of a bold move and go out there and really convince people that they're on the right track. For that, of course, first we need some numbers to improve there.
Does it get even harder to attract some of that capital from investors at a time where you're seeing this great performance elsewhere in Europe, just in terms of the stock performance?
Yeah, definitely. I mean, if you want to look for long-term investors, you really have to convince them that the low is near and that you are able to pull off that turnaround. And there's very little evidence that the bank has given us that it's able to do so. What's more is, if you talk to portfolio managers, as I did today, two of them told me, unisono, that they have very little incentive to buy the stock at this point, because it's just unpredictable what will happen, and you don't want to have a stock in your portfolio and you have to wake up every morning and check the ticker first if something else has happened. So as long as that prevails, I guess it's going to be very hard for Credit Suisse to attract fresh investors, and if they want to, it's going to be expensive as well.
The good news is that it has kind of recovered going into the close. Jan-Patrick Barnett, the bad news is it still trades at around 250, 260 over in Switzerland. Down on the year, on a year where UBS is up on the year by something like 15% the last time I checked, and the European banks on the Euro Stocks 50 index, the European banks are up 22% year to date, and absolutely flying. 22 minutes into the session right now, we're higher by 0.5% on the S&P, on the Nasdaq up by 0.6%. Let's get you some sector price action. Here's Abby.
Hey, John. Well, most sectors today are trading higher, led by energy up 1.5%. This, of course, as oil is up about the same amount. We also have tech higher, industrial, so strength here overall, but the financials, not so much, down about 0.8%. And a lot of this has to do with SVB Financial and the share offering, their new guidance guidance. In fact, if we take a look at the regional banks, because we've covered the big banks pretty nicely this morning, regional banks right now basically at a 2-year low, down about 20% over the last year. SVB, a big piece of it. But you also have to wonder about the Silvergate fallout. Not a part of the index, but just that contagion fear, John.
Abby, thank you. Amazing to see a 10 basis point move at the front end of the curve. 497. That's the point in your equity market just a little bit this morning. Going into payrolls tomorrow. Your trading diary up next.